Well, a passive strategy would be kind of set it and forget it is another term for it. What you do is a lot of index investing in like Vanguard, they're a great place. You just buy a bunch of indexes and you can put it any way you want, 60-40, 50-40, 70-30, 100% stocks, whatever. And you just set it and forget it. The strategy there is that the market will overcome any kind of inconsistencies, right? And you're doing very low fees. And so the strategy is over the long term, you're probably better off in a long-term strategic or passive kind of investment. So that is what the set it and forget it. The strategic or tactical asset management believes that you can take advantage of different economic conditions. You can put in hedges against losses. You can do a lot of those kind of things. They cost you a little bit more. You got to pay an advisor or a management company or whatever. But they believe that you need to take advantage of these kind of things. And so are both of them bad, both of them good? No, they're both good and bad, really. There's really no bad to either one. For younger people, though, when you have a long time horizon, like you're 30, not going to retire till 60, whatever, passive is a pretty good argument for just setting it and forgetting it and not worrying about it. Really, there's a really good argument for that. Don't get me wrong. If you're a risk-averse person, even if you're 30, you can do a tactical risk management type of strategy. But for younger people, I'd say 90% of the time I recommend a passive strategy at like Vanguard or Fidelity or Schwab, whoever the big trustees are, and that just stay in the low-cost funds. You don't have to, but the individual stocks are, you can do it or not do it. The individual stock's going to give you more risk because, individual, obviously, when you have got just the S&P 500 has 500 stocks in it. And so having even 10 or 15 stocks go down a lot is not going to hurt you. You have, 5 stocks, one stock's going to kill you, right? And so you can do that, but I would keep the indexing part the most. Now, when you reach a certain age, it depends on when you want to retire. We're talking about maybe 50, certainly 60. You might consider tactical management. And also depends on what the market is doing at the time. If the market has just experienced a huge downturn, sometimes strategic is going to work really well because the upswing usually is pretty good. If you're in a long bull market and you're 60, definitely consider tactical. We can talk about it a little more in depth after the break.